Saying, "I invest in crypto," means absolutely nothing today. Tell a broker you invest in paper. The idea of a single, unified asset class shatters the moment you look under the hood. We started in 2009 with one network, Bitcoin. Today, that single concept has fractured into a chaotic market of thousands of distinct projects spread across 17 entirely different structural categories. Faced with this wall of options, investors freeze. They end up glossing. They buy an asset designed for extreme volatility when their actual financial goal was daily stability, simply because both tokens have the word crypto attached to them. We are going to bypass the social media hype entirely. We will evaluate these digital assets purely on their mechanical reality, how they function, what they cost, and what they actually do. Treating a functional utility tool like a speculative stock, or treating an internet joke like a secure savings account, is a math error. It is the primary reason that portfolios are wiped out. To navigate this landscape and survive it, you have to map every asset against two strict variables: technological utility and speculative risk. This chart maps underlying utility on the y-axis against risk level on the x-axis. In the high utility zone, we find foundational assets that build networks and functional tools making them usable. On the extremes, regulated assets sit low risk, while speculative tokens occupy the extreme risk, zero utility corner. The math here is unforgiving. Assets engineered for daily stability strictly cap your investment returns. Conversely, assets offering massive upside require you to sacrifice all fundamental stability. You cannot have both. Moving forward, the rule is simple. Your goal is not to find the single best coin. Your goal is to precisely match an asset's structural mechanism to your true financial intent. We start at the foundational layer, Bitcoin and Layer 1 networks. Layer 1 coins operate on their own independent blockchains, handling all core transaction processing and security. They are the decentralized bedrock of the ecosystem. This comparison matrix shows the reality of Layer 1 investments. While they offer the highest relative safety and direct exposure to core infrastructure, they subject the investor to severe, multi-year cyclical volatility. From the foundation, we move to the functional tools. This includes stablecoins. Stablecoins are tokens designed to maintain a steady value, usually pegged to the US dollar. They use reserves or algorithms to solve crypto's biggest user flaw, price volatility. Looking at the expanded matrix, we add the other efficiency mechanisms. Layer 2 tokens exist on top of existing blockchains to process data off the main chain and lower costs. Wrapped tokens are versions of one cryptocurrency adapted to work on a different blockchain. Exchange tokens are issued by trading platforms to reduce your fees. Notice the trend: high utility, but zero to low volatility. There is a massive disconnect here between utility and profit. These functional tokens solve critical user experience problems, but they are engineered strictly as tools. They are not growth investments. Holding a stablecoin or a utility wrapper makes the network usable for you, but it yields exactly zero capital appreciation by design. Expecting a return on them is like expecting your hammer to pay you dividends. Next, we enter the ownership economy. These are the high-effort ecosystem tokens that grant you access, voting rights, or power specific decentralized applications. This includes governance tokens. Governance tokens give holders the right to vote on project decisions, removing central authorities and allowing the community to dictate how project funds are used.
This flowchart demonstrates the mechanics of DeFi tokens and AI tokens. DeFi tokens are used in decentralized platforms that offer bankless lending and borrowing. AI tokens incentivize machine learning models. As the chart shows, their entire financial value is strictly chained to the volume of active daily users on their parent platform. To participate in these closed ecosystems, you need utility tokens and NFTs. Utility tokens pay for transactions within a specific project. NFTs are unique digital assets that represent ownership of a specific item, acting as a digital property deed or entry ticket. The hidden vulnerability here is absolute dependence. Unlike Bitcoin, the value of these builder tokens is completely tethered to the active use of their specific platform. If the underlying app fails to attract users, or the current AI trend cools off, the associated token collapses to zero. This happens completely independent of whether the broader crypto market is healthy.
On one far end of our spectrum, we have the regulated bridge to traditional finance. This includes security tokens, which represent regulated ownership in real-world assets, like company shares, and RWA tokens, which put traditional assets like real estate and bonds on the blockchain. This matrix contrasts the trade-offs. RWA tokens provide global liquidity for traditional assets, but they require strict KYC compliance. KYC stands for Know Your Customer, a legal requirement to prove your real-world identity. This compliance destroys the anonymity that blockchain purists crave. Pivot sharply to the opposite extreme, the speculative realm. This is the domain of meme coins. Meme coins are cryptocurrencies inspired entirely by internet culture, jokes, and viral trends. Meme coins lack all technical fundamentals. Their pricing relies 100% on social media momentum and community engagement, carrying the absolute highest risk of total capital loss. We also see privacy coins in this unregulated space. Privacy coins use advanced cryptography to keep transaction details anonymous and untraceable. While they offer true financial privacy, they face severe regulatory crackdowns, making it nearly impossible to cash them out on major legal exchanges. Blindly jumping between heavily regulated real estate bonds and hype-driven internet jokes without understanding the mechanics of either is a guaranteed recipe for portfolio destruction. A smart investor brutally subtracts noise. You do not need to own something from all 17 categories to be successful in this space. The decision tree starts with your primary goal. The beginner profile seeking wealth preservation routes to Bitcoin and Layer 1s. The optimizer profile using open finance routes to DeFi, Layer 2s, and stablecoins. The speculator profile chasing returns treats meme and AI tokens as total loss. The categorization proves a hard truth about digital assets. Safety, utility, and explosive growth never exist in the same asset simultaneously. The illusion that traps so many people is the assumption that every digital token is designed to be a lucrative, appreciating investment. When you strip away the culture and the noise, a blockchain is nothing more than a distributed database structure. Intrinsic value does not magically appear just because an asset has the word crypto attached. Value comes strictly from the specific utility and the hard-coded mechanics of the individual token. Survival in the digital asset landscape isn't about picking the winning coin. It is about ruthlessly matching your true financial intent with the exact right technological tool.